Welcome to the presentation that the European crisis is caused mostly by free trade violation and trade deficits. This is an unusual presentation. It's very arguable, but the goal of the presentation is to make people realize how much more important the trade deficit is than people realize in the European crisis. One of the key basic principles of free trade is that money should come back to the country of origin. Now, some people might argue that this is not a basic principle, but is really just a goal. Whatever you have it, it's a very good practice. Now, here's an example. A Chinese company that trades with the U.S. receives dollars, but China's currency is yuans, not dollars. So the Chinese company will trade the dollars for the yuans at a Chinese bank. However, the Chinese bank is now stuck with the dollars and must reinvest that money back in the U.S. And they'll do so by buying treasuries, U.S. businesses, etc. So we see that this is a very good thing in the United States and a good practice. However, the euro currency violates this goal or principle, or whatever words you want to choose. And because of that, China or the U.S., for example, when we trade with Greece, receives euros, no longer, say, a Greek currency. So China or the U.S. can reinvest those euros anywhere in Europe, not necessarily back in Greece. So the wise choice, if you had euros that you got from Greece that you would want to put back in Europe, or you had to if you were a bank, you would probably invest it in Germany, which is a more solvent country. So this is the problem, because this is a major problem, because the trade deficits of, say, Greece is 15% GDP per year, Portugal's 12%, Spain's 21% in 2011. So these are rough numbers, but year to year they vary. But the reality is that in 10 years, the money will flow out of that country of origin. Say 80% of it doesn't come back. And it's a big problem. So Greece and Spain and these countries are losing euros to Germany, which gets the euros. It's kind of like, well, it's raining in Germany, but it's never going to rain in Portugal, or hardly ever rains in Portugal, Greece, and Spain, so nothing grows there. How do euro countries attract the euros? Well, there's foreign direct investments, and this often results in the country's precious assets, because Greece is saying, well, we need money, so Germany, you come and buy us up, and they buy their precious assets. They can receive money from the central bank, that's a bailout, or they can sell government bonds, but as they get more and more desperate, their interest rates go up. There's also like a violation in the United States of this principle. So it's not so perfect in the United States as our first example, because there's a thing called deferred taxation. Just wanted to mention this, although it's not part of the focus of the presentation, because the deferred taxation money stays overseas. Currently, there's about $1.4 trillion, according to the New York Times, that's held overseas. And the money is not coming back in the U.S. in a timely manner, because if these companies bring it back, U.S. companies, they will be highly taxed. So there's no vehicle for them to bring it back. It's not good government policy, which is what is occurring. Now, as we mentioned, well, if a country starts to run out of euros, like Greece, Spain, or Portugal, what happens is that their national debt will skyrocket, because there's not that much money floating around. You need circulation of money for full employment. And after all, excuse me, after all, citizens actually have to pay off the national debt. So citizens all over the world are thus funding their country's trade deficit, helping corporations, both foreign and domestic, and this is somewhat true of the United States. A lot of people think that the national debt causes higher trade deficits, but it's actually, the data is the other way around. It turns out the causality analysis, the causality studies, statistical studies, show indeed that trade deficit causes higher national debt. And that's in our book, Forgot to mention that most of this work comes from the book, The Trade Deficit, Legal and Unconstitutional Effects Destroying America. So we recommend balanced trade. It's far superior to free trade because balanced trade would eliminate trade deficits, the selling of a country's assets, this foreign ownership that is being caused in the U.S. and probably in all these European countries, the creation of national debt. It would stop foreign cheating. There's currency manipulation by China, which is a major problem. It encourages manufacturing and jobs. It provides a true competitive advantage and would ensure a country's future of not being sold off. And there is no trade agreement in the World Trade, the WTO, the World Trade Organization, that says you cannot seek to balance trade. In fact, if we could send a man to the moon, countries can find a way to balance trade. And this book explains why trade deficits cause unjust activities, although it targets the United States and the fact that it's causing a lot of problems in the United States, these grossly high trade deficits. The book recommends actually that trade deficits cause illegal and unconstitutional effects in America and likely abroad. So we think that citizens should bond together and bring these to the higher courts and try to get governments aware of the problems that trade deficits cause, because really politicians are often lawyers and they really do not understand or have political economic tools. Like this book suggests some political economic tools, very strong political economic tools that lawyers could use to understand the economy. So there you have it. We're trying to raise the level of awareness that trade deficits are actually a big part of Europe's problems. We do recognize, we would like to say with a caveat, we do recognize that national debts and things like that are very complex, and the European crisis is very complex. But yes, the trade deficit is playing a big role, and it's very unrecognized. Thank you.